I'm Deborah Frieze, founder and president of the Boston Impact Initiative and a professor at Tufts University. And this module is going to explore raising investment capital. So there's raising grant capital inside of it, but we're going to focus primarily on the investment capital. And the questions we're going to explore today are, first, where does impact first investment capital come from? So lots and lots of places to get market rate or higher return capital. So what happens when we're looking to get impact return first? The second question is, what role do foundations and philanthropy play in the impact investing ecosystem? So there's investment capital from the market where people are looking to make impact investments, but they are not about philanthropy. And then there's the role that philanthropic institutions play as investors. And the third question is, who influences the decisions about how impact investing dollars are allocated? So this issue of agency and power and decision-making is a critical part of the inquiry into raising investment capital. So I want to actually use the integrated capital cards to help us with this module, because there is a suit in them called funding sources. So if you have a deck, you pull out the funding source suit, which is the blue suit. And this is actually going to tell us all of the folks that we're going to look through is what I'm going to review today. And so these include, the first category is the market rate, market-oriented lenders and investors. And so here we have venture capitalists and private equity firms. These are both very much seeking high growth, high return type of investments. I also have banks in this category. And all three of these are market rate. They're not about impact first. That doesn't mean there might not be a version of a VC or a bank that's focusing on impact, but for the most part, they're market rate. And they have all kinds of constraints and requirements. Like I said, a lot of growth for private equity and venture capital. In the case of banks, there are constraints that they follow, like you have to have 2 years of revenue already, or we need a personal guarantee, which means you've got to have some collateral of some kind, maybe your house or your car or some business collateral, and a good credit score. And so a lot of folks feel left out or can't access capital. And one of the critical things, and you'll see this when I go through the other suits, is most entrepreneurs think, if I can't get a bank loan and venture capital isn't interested in me because I'm not high growth enough, that's the end of the story. And the good news is it is not the end of the story. There's a lot of other places to look for capital. So the second category is the community investment vehicles. And this is really the bulk of what we've been exploring in community-based investing, right? And these are places that we may have heard of already, like CDFIs, Community Development Financial Institutions, and CDCs, Community Development Corporations, that do a lot of lending activity. CDCs particularly in real estate. CDFIs also a lot of affordable housing and small business lending. We have groups like Charitable Loan Fund, which is what Boston Impact Initiative is, as well as a diversified business fund, and in generally an impact investing fund. So this set of special vehicles that have been created for impact first investing and community-based investing. And finally, with some trepidation, I put credit union in here. So some credit unions behave a lot like banks, but they could also be community investment vehicles. So credit union with a question mark goes in this category. And because this is really the subject of this course, we're not going to be diving into this one today, but wanted you to see what is included in that category. The third bucket, which we are going to dive into, is foundations and philanthropy. So here we have community foundations, private foundations, corporate philanthropy, and a special vehicle called the Donor Advised Fund that we'll dig into for individuals. The fourth category is what I call angels, devils, and their agents. You will see why, because we're going to dig into this one. We have accredited and non-accredited investors. I'm going to go through the distinction between essentially wealthy investors and non-wealthy investors. Angel investors, the particular role that they play in early stage, often startup and catalytic capital. Family offices, which are mechanisms that high net worth families often use. And their agents, so the registered investment advisors, the RIAs that do a lot of advising here. So I called it angels, devils, and their agents because you have angel investors who sometimes can behave like devils, and the people who are making decisions on their behalf, which is the RIAs. And then the last category is the anchor institution category. And here we have the eds and meds, universities and hospitals. These are the places that often don't pick up stakes and move. They stay in the community, like faith-based institutions as well, the churches and synagogues and other institutions that stay put, and then government and quasi-government agencies. And this is covered in another module. So today we're really going to dig into the philanthropy and foundation category and the angels, devils, and their agents. What I want to be clear about is that the distinction between what is an impact first and what is market rate doesn't necessarily lie with the type of entity that it is. Someone could create a solidarity venture capital fund or a market-oriented CDFI, right? It's just a structure, and you have to layer it with your values and beliefs. So that's what we're going to focus on. What I want on a high level, what matters here most is the question about how would you think about where to turn for capital if you're an entrepreneur? How do you choose your investors? That question may sound counterintuitive to most entrepreneurs. Capital seekers often think, I'll take whatever I can get, right? We want to flip that. In an economics of relationship that we've been trying to build in community-based investing, every relationship should be based on mutuality, reciprocity, and trust. And so it's not just about taking whatever you can get. I realize this is aspirational and maybe not working with the constraints on the system today, but this is what we're trying to build. And I want to give an example. I participated once in a pricing meeting hosted by an organization called RSF Social Finance, which is also a charitable loan fund. And they were bringing together farmers who needed to borrow capital and investors, lenders who wanted to give them capital. But these weren't necessarily very wealthy people. Sometimes they were people with some money that they wanted to invest in alignment with their values around food systems. And maybe it was somebody who's saving for retirement. And so the farmer would say, I need this amount of money at this rate. Let's say I need $50,000 and I can afford to pay back at 3%. And the lender says, I can't afford to give it to you at 3%. I need to get at least 4 or 5% for my plan. And they would discuss and learn about the opportunities and constraints on both sides, and then come into relationship and decide what is the right rate at which the lender should offer the farmer money. So that's actually the opposite. We usually do finance through intermediaries. It's anonymous, it's transactional, it's often opaque. And here is about restoring relationship. And so the invitation in community-based money is to really think about flipping the power imbalance, right? And actually being in conversation about who should you take money from, who shouldn't you take money from. There's obviously a lot of strings attached to a lot of capital, whether that's corporate capital or even philanthropic capital and other investment capital. There's questions about where did they make their money? Where did it come from? It's a tricky situation to say, I don't want to take money from a big bad company. I'd rather take it from this family office, for example, but you'd have to ask, where did that family office's wealth come from originally? So lots of inquiry here, no right answer, but really important to both be in the question about what would it mean to be in right relationship, to flip the power imbalance and come into relationships. So it's not that capital providers have power and capital seekers don't. And really, ultimately, what we're trying to do when it comes to raising investment capital is to seek an alignment of sources and uses, meaning the source of capital, which is where you're getting the capital from, the use of capital, what you're going to use it for. And if you think about an alignment of sources and uses, we often talk about that in terms of financial needs. Think of it also in terms of values. What are both sides of the equation trying to accomplish? What do they have that they care about deeply together? That's the bigger inquiry in raising investment capital.